Hey, it's Rob. Welcome to Everyday Investor, the hottest investment show in the world. That's right, I said it. I don't care who knows it. Remember, whenever you're faced with any type of investment opportunity, you always ask 4 questions to start. 1, what is the return on investment? 2, when do I get that return along with the money that I put in? 3, what is the minimum investment amount needed? 4, what is the risk, the worst case scenario? This show has been designed so that we can grow our money. You see, we take our precious time, we go to work, we get a paycheck in order to provide. But imagine a world where money would make you money, so you could work a little less if you wanted to, and take that precious time, spend it with family, friends, engage in a purpose that's greater than yourself. Thank you for tuning in to Everyday Investor. We've got an incredible show today. We're going to be talking to my good friend. Wait for it. We'll be right back. Coming up, we talk to Melanie Dupuis, and she teaches us how we can get the seller to give us a mortgage.
Many of them were owner financing. Now, that being said, the reason that people are willing to do this is because it's doable. But first, you have to understand that yes, it's doable, yes, it's legal, and they do it because there's reasons for them to do it.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, welcome back to Everyday Investor. Before we learn from Melanie, let's see what's happening in the world of stocks with stocks expert Omar Khan. Over to you, Omar.
Thanks, Rob. Omar Khan here, guys, with TheTA Training. Want to give you the weekly market update. Markets continue to grind higher. Why? Because corporate earnings are ultimately what drives stock market prices higher. Corporate earnings have been coming in really good with Apple and Facebook and Microsoft, all the big names, Tesla. They're doing really, really well in terms of their earnings. And these kind of companies, Amazon disappointed a bit. But the main thing is the consumer is healthy, which means they're spending money, which means these companies are making a lot of money. Now, August and September are traditionally weaker times of the stock market, weaker times of the year. So let's see if we get a bit of a pullback. But based upon these corporate earnings, there's a high likelihood that the second half of the year, because of these high earnings, will look pretty good. But we'll see. Ultimately, like I said, earnings, the amount of money a company makes, that will determine how high or low the stock price goes in the future. Back to you, Rob, and we'll see you guys next week.
Thanks, Omar. Always great to learn from you as usual. Melanie, thank you so much for doing the show with me.
Hey, nice to see you again, Rev. Thank you so much for having me.
Yes, no, it's great. And of course, I had Dave on TV a few months back. Here we are in August, and I'd love for the both of you to be on, but you're just such a fire hose of knowledge that this show really only has 22 minutes if you don't count the commercials. So that's why I've got to get the Dupuis individually. Next, it'll probably be your kids.
There we go. Excellent.
Yes, and speaking of kids, thank you for posting so much on social media. I get to see them all the time, and you've really got them into the investing game as well. Talk to me a little bit about the age of your kids and what you're doing to kind of expose them to this world of investments.
Yeah, and thanks so much. So two oldest, 2 girls, 16 and 13, and my little guy is 6 years old. And honestly, the way that I involve them is just by them being around us. Dave and I, because we are full-time investors, this is our world, and they just get to see us. Today I came in the office, for example, but I got here at 2 o'clock, so we're at home with the kids all day, playing with them. Went in the pool, but then they hear us making some calls, and they're just around it all the time. And they saw us in the past working full time, the 9 to 5, or in fact, Dave was full-time firefighter, so he was on shift he was on shift all the time. So even they got to see the different lifestyle that we're able to have because of real estate.
And I don't want people to think that you don't work hard, though. You guys are working hard, and if somebody were to look, a third person were to look at your life, they may think, Rav, what are you talking about? The Dupuis, they hang by the pool, the cottage, so on and so forth. But what they don't realize is sometimes we're cursed a little bit as entrepreneurs because this is always working. You know, the mind is, we could be relaxing, sitting at the beach, but it's often hard for me anyways to turn this off. And, you know, it took 6 years ago for a bit of a neural breakdown for me to really work on myself to turn it off and really be present as opposed to dreaming and thinking. I mean, Melanie, I'd drive by a empty piece of land and wonder, hey, how many units of storage can I get on that? Or how many tractor trailers can I park on that? Or, you know what I mean? Meanwhile, I'm supposed to be having a date with my daughter or whatever the case. Do you find that as well, that, you know, it's a blessing to have an entrepreneurial gift set, but it's also a bit of a curse because it's hard to turn off?
You know, I've learned, oh gosh, this is probably about 8-9 years ago. One of my mentors had told me, when you're in the room, be in the room you're in. And it's something that, you know, has always stuck with me. And the thing about being an entrepreneur, did we work? I mean, and yes, now I have a lot more freedom than I've ever could have imagined having at my age before. But yes, they don't also, people may not have seen the late nights that I put in the past together. It doesn't happen overnight. You want success, you got to work for it. But when it comes to the balance of it, I think that's really it. I mean, it's being in the room when you're in the room. And I get what you're saying. It's, you know, it's, of course it's always on, but I almost don't see it as a negative. Like it's a passion. It's what we love it. The things that I've noticed I didn't love, what I've really been making an effort, a conscious effort, and we've been making a lot of business shifts, is exactly for that. Whatever I don't enjoy, whatever is like that burn or that stress, which we don't want, of course, entrepreneurs, because they can easily, you know, you can't take on too much sometimes. It's just the delegating. So we've grown our team a lot. So that way it just, the tasks that I don't enjoy or that was stressing me, I don't have to worry about that anymore. The things I did not want to even worry about overseeing, even though I wasn't the one overseeing it, but still it's still there, like property management, we're getting rid of all of that. So we've made a lot of positive changes just to help with that as well.
No, that's great. But truth be known, there's just some things that you cannot replace. For example, we're going to be talking about how to get the seller, when we buy their property as an investment, how to get them to give us the mortgage. I don't think anybody on your team, maybe Dave, but I don't think anybody on your team can do that. That's you with the gift of negotiation and the subtleties and the way you approach it. I'm just guessing. That
it's interesting you say that because, and again, you know, to have the conversation, yes, but there's a lot of pre-work that can be done. These deals happen, but they don't happen for every single deal that you look at. I don't have to be the ones looking at all the deals. We can have people doing those kind of things. So that way, hey, if I have to spend a 20-minute conversation with somebody on the phone to discuss owner financing, and I'm okay to do so because I know the numbers work, I know I have my exit strategy, I know everything else, I just save myself a lot of time. So yes, I agree. Right now, we do want to be the ones negotiating at this stage, but I also have a team that helps with the behind the scenes. So hey, I'm okay to spend 20 minutes on a phone call because I know everything else has already been done behind the scenes.
No, love it. Okay, so I mean, you guys teach, you coach, you help invest Rav's money per se, whether it's kind of a debt deal. I lend you money for a specific investment and then there's a fixed return. Or it's a promissory note. Explain a little bit what that even means, a promissory note.
Yeah, so essentially a promissory note, it's a fancy legal name for a contractual agreement. So it's an agreement where Rav decides to lend me whatever amount. It could be 10,000, it could be 400,000, it could be more, to lend me money, and it could be for different things. It could be to help me come up with them, and that's the nice thing about it. It's really flexible. As from the person who's in creative financing. So it's very flexible for me. If I need to use part of it for renovations to get my forced appreciation or the lift that I like referring to, I can use it for that. I can use it to pay my lawyer fees. I can use it to pay the actual 20% down, for example. So you can use it in different ways. But of course, you don't just use it, right? It has to be very strategic because Mr. Rav's going to want to get paid back his interest because that's why he wants to do it. And he wants to I need to make sure, of course, as the investor, that I do it in X amount of time that we agreed to.
And so the difference between the typical private lending that Rav would do to investor Mel Dave, as opposed to a promissory note, the difference is there a difference on the return? Like if Rav is going to lend you money, $100,000, but it's secured on a property, as opposed to just writing a promissory note because you've got a great reputation, I have a relationship with you guys, is there a difference there in terms of a return?
Yes, typically there would be. Yeah, there you'd get when it's a promissory note and not. I mean, there's no lawyer fees necessarily involved. So yeah, the interest rate would typically be higher when it's just a promissory note.
Promissory note, and we're talking it could be 9, 10, 11%, something kind of in there. Depends on what we're doing.
It depends on what we're doing. Depends on the amount. Depends on the amount of time. And for me, it's not really about the amount. It depends on the deal itself. I've paid lower, I've paid really high as well because I knew that it would pay off and I would get a huge lift of it, and I was okay with that and make it a win-win with my lender. So it really, really, truly depends on the deal. But yes, typically promissory notes are always higher.
Yeah, great. No, because when we talk about this show and we're going to be talking about how to get the seller to give us the mortgage, that's active investing. There's a lot of Ravs out there that, hey, I want to learn about it, but I'm not going to probably do it. I want to give my money to the Mel Daves out there, and you're saying there's many ways, but a couple of ways we just mentioned is private lending, secured on real estate, a great return, or promissory note, same kind of thing, but not secured, based on relationship, and obviously a higher return as a result. So let's talk about the reasons. Teach us about this. Teach us about this concept of getting the seller to give me the mortgage. We call that seller take-back mortgage. We call it vendor take-back mortgage. We call it creative financing, all that kind of stuff. But in essence, as I try to make this, grade 12 friendly, if you will, it's we don't need a mortgage from the bank. We can get the seller to give us the mortgage. Can we go all the way up to 100% even, or how does it work?
You can get up to 100%. And I think number one is even knowing that this is legal and this is doable. And I'm bringing it down to the basics here because yes, now we do that all the time. We bought 12 properties in 12 months, as I'm sure some of the listeners may know if they follow us. Many of them were owner financing. Now, that being said, the reason that people are willing to do this is because it's doable. But first you have to understand that yes, it's doable, yes, it's legal, and they do it because there's reasons for them to do it. So number one, it does not work for everyone. You will discuss it with some lenders, you will speak with some owners, and they say, I'm not interested. I'm continuing to grow my portfolio. I'm taking my money and buying the next property, the monopoly game. So it might not work for them. Number two as well is that they may not want to do it because they want to take that money and retire or travel with it. So that's just the reality. It doesn't work for everyone. Okay, now who would want to do such a thing? It's for those who, for a couple of different reasons, want to continue to make money on their money with interest rate. Because of course, with any time you do creative financing, you pay some kind of interest rate. So interest rate is one of the reasons they want to do it. Number two, so there's really three reasons why they would want to do this owner financing. Number one is because they want to get that extra little income from the interest. Number two, if it's not already listed with an agent, they want to avoid those fees. But you can absolutely do this with an agent. I do it very, very often. I work with a lot of agents as well who are very open to this. And number three, it's for tax purposes. It's huge for them. So if somebody's selling and they're not at the highest tax bracket from a tax perspective, I'm not going to get into the details of taxes here, but it benefits them from a tax perspective. That's why a lot of sellers who decide to sell, all of a sudden, they don't want to be taxed in one tax bracket years. They like to defer it over a couple of years. Okay,
so seller gives Rav the mortgage. I see a property. For whatever reason, I'm not going to the bank, I'm self-employed, blah, 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 and I want that seller to give me a mortgage. It's legal, first of all. This isn't shady. This is creative financing. Number two, it's not going to be for all sellers. And so who it's ideal for is if that property, let's say it's, I don't know, let's call it $500,000. Free and clear, $500,000. He's just going to take that he or she's just going to take that $500,000 and lend it to Mel and Dave anyways, and make their $50,000 a year at 10%, whatever it is. So why not instead you give me the mortgage and I'll pay you monthly over a defined time. Is that what you're saying?
Yeah. And the nice thing about it, there's just so many ways that you can do a deal. And I'm sure we'll cover some of that today, but keep that in mind. If you're thinking, well, I heard somebody else did it that way, probably because it was part of the negotiations. And when I look at my own deals, and I know that I've talked to you before on one of the previous shows about a sixplex, a certain way I've done it. I know Dave did one, and I will be doing another one today. But that's the thing; every deal is different. There's balloon strategies. That it's really finding out what can the deal sustain, and how can you make it a win-win with the owner so they're willing to hold that financing for you.
Love it, love it, love it. They're going to do it anyways. They save on fees perhaps if there's no realtors involved. And then obviously we won't get into it. They can talk to her accountant. You guys talk to your accountant, but there's lots of tax benefits. We're deferring, so on and so forth. Perhaps it's not principal residence and it's an investment property that the seller has, and he can defer that on his capital gains or whatever the case is. Let's take a quick break and then we'll come back and dive in deeper and then even look at a live example that you did with getting the mortgage from the seller.
Awesome.
Awesome. All right, we're talking to my friend Mel, and she is a wealth of knowledge. Don't go anywhere. We'll continue when we come back. Everyday Investor continues in a moment.
At TheTA Training, our goal is to help you achieve financial freedom by teaching you the foundations of trading stock options. Join our growing community. Learn through our live-streamed weekend course, or develop your skills at your own pace online. Understand how the stock market works and how you can use the options market to earn additional income. Achieve financial freedom and live life on your terms. Let us help you build your empire.
Hey, it's Rav. Welcome back to Everyday Investor. We are learning so much from Melanie. Before we continue, learning how the seller can give us the mortgage, let's find out what's happening in the world of mortgages with mortgage expert Kyle Ford. Over to you, Kyle.
Thanks, Rav. This week I want to talk about appraisals. Appraisals are done at the time of purchase or refinance to establish the value of the property. There are many times that we could use what's called an automated appraisal system. This means there's enough data out there and the value and the price that you've paid for the property is in line with all the other data that the lender may waive the need for an appraisal. In many other cases, often in the event of a bidding war, if the property is sold dramatically above list price, the lender is going to want to send a certified appraiser out to determine the value of the property. As long as the value of the property is in line with your purchase price, you're good to go in the purchase. However, if you have paid more than what your property was appraised at, even if you are pre-approved for that amount, you still need to pay that in difference. Example, if you purchased for $1 million and only appraised at 900, not only would you have to put the 20% down on 900, you also have to put the additional $100,000 difference down. This is why a financing condition is always recommended. If you have any more questions on appraisals and other mortgage financing needs, don't hesitate to reach out to myself and the Kyle Ford Mortgage team. Thanks. Back to you, Rav.
Thanks, Kyle. Always great to learn from you. Melanie, always great to learn from you as well. And we were talking about this is what you do often. The seller gives you the mortgage. It's legal. It might not be for all sellers. And so therefore, we talk to a lot of people. I mean, it's a numbers game. Most things are, right? But the reason why a seller would do it is they're just going to sell the house and invest it anyways. So why not do it like the way you're about to teach us, one of your deals? They want income. They want monthly income. And so this is a good fit. They save fees on realtors, and there's huge tax benefits to this. So talk to me about one of your deals that you did and how this worked.
Yes, and I'll give an example, a very common way that I do it. It's probably one of the most popular ways. So hopefully that will help some of your listeners. So I'm going to give an example of a fourplex. This one I purchased in 2017. And the purchase price back then was $345,000.
$345K. And so
Exactly, yeah.
I know Mel has $345K in her purse, but we didn't want to use it. It would be smart to use other people's money, such as the bank or the seller. So what happens?
Yes. So and banks typically don't do creative financing, especially in this early cycle of the deal. So I went to a mortgage broker, and he was willing to lend 80% of the deal. So it's a fourplex, so you can do 20%. So he did 80% of that.
So he gave you 80%, which is common as an investor. You're supposed to come up with the other 20. So 80% of that is how much?
276, yeah.
276. Let's say 275 for fun. So then Mel needs the other 20%. And I know you have that in your purse, but again, it'd be nice if we used, or maybe that's in Dave's wallet. This much is in your purse and the 20% in Dave's wallet, but we don't want to use that. So what do you do?
Exactly. And why would we not want to do that? Because then you're stuck again. Then I wouldn't be able to continue to grow because I have no backup money. So you take I spoke with the owner, explained the benefits to them, explained my exit strategy, how I plan on paying him back in X amount of time, paying him interest. So he held the second mortgage of 20% down. So using that, it's around $70,000.
70,000, yes. Okay, so this was 70K, but this came from the seller.
Exactly. And just a note on that, if somebody just purchased it and they want to sell and there's no appreciation, they have to have that in equity in order to do that. So they can't lend you more if he has to have at least, like, for example, that 70K. Otherwise, they can't do it. And this is why this way is even more popular than 100% finance, because if it's 100% finance, it needs to be completely paid off.
Got it. Okay, so he is the one that gave you that. And then what was the terms on this?
And I can't even remember, to be honest, the exact terms, but I think we had 5 years to pay it off. I think we kind of did a deal where the interest would increase over time. So it's kind of an incentive for me to pay it off sooner, and advertised over 25 years.
But this is not this is not what we can get today, August 2021. You were paying him more than 2%, I'm sure.
I was actually, it was pretty low. And again, with owner financing, I paid anywhere from 3, I've paid 7, I paid everything kind of in between and higher. So it just depends. But it made enough that I still profited back then. It wasn't huge, but I still profited about $500.
So you paid him maybe a bit of a premium, maybe at the going rate, and you were still cash flowing. It paid your expenses. He's happy for the reasons that we said. He wants some income monthly anyways. So you paid him over 5 years or 4 years in this case, monthly. Over that whole time, he was lending you the money.
Exactly, yeah. And I think it might have been interest only. Or I can't remember if this one was premium, but either way, it was a portion of the mortgage. The whole point of it was to pay him out at the end of the term.
Okay, so Mel, Dave don't have to have any money in the deal per se. I mean, obviously you're going to if you're doing rentals and whatever the case is, but even that I'm sure you would borrow. Then secondly, the seller, happy, maybe no commissions, better for tax purposes, gets monthly income, which he wants anyways, right?
Yeah, exactly.
And so now what you said you're doing something interesting with this deal now. It's 4 years. Now what are you doing?
Yeah, well, this one, it's kind of, so we actually ended up refinancing it about 1.5 years, 2 years into the deal. So we refinanced it in 2019, so about 2 years afterwards, for $360,000. So that allowed us to pay back everybody. So 2 years ago, everything was paid out. We paid back the lender. And when I say 360, that was a new mortgage on it. So we got to pull the new mortgage of approximately 360, paid off the mortgage and everything. So that was done 2 years ago, which was nice because now I'm also paying lower interest. Because yes, when you're dealing with the bank's money, a mortgage broker typically will be lower than the owner. So that was nice. And then what we are decided to do now, again, it's adjusting to the market and what's going on. We actually decided to sell this property because we're diversifying our portfolio. We're going to different provinces and states as well. So we just sold it recently for $550,000.
Wow, $550,000.
$550,000, and that's the deal that I literally put none of my own money to get into the deal, other than, like you said, the basics of, yes, some renovations, but I also cash flowed throughout those 4 years as well.
So what do you think you made on this thing?
Yeah, and I just want to grab my calculator quickly. So 550 is what I sold it for. Let's say it was, I don't know, 27,000 in realtor fees. I don't know, 100, say 150 or
Yeah.
so, probably around there. Yeah.
So you made 150K over 4 years, which is, like, but it was none of your own. This was none of your own money in this deal whatsoever. Even the rentals you did, okay, when you refinance, it takes care of. So, you're making your $35,000, $37,000 a year on one deal, not using any of your own money. And I know you do this with multiple, projects at a time. No.
That's the power of real estate when done properly.
Yes.
Yeah.
So Mel, what's the biggest thing? So now you're saying, and I love that you're doing this. I think I saw Dave on social media talking about it. That, it's not like buy an investment property and hold it forever and give it to your great grandkids. No, it's about, helping them. But it might not be a property. It might be a storage facility. It might be an apartment building. It might be, a chunk of money to lend out and get. And so we're playing a game of Monopoly. You and Dave have decided, yeah, okay, this is our portfolio. We want to now liquidate a portion, and now we want to get into other provinces. We want to get into other countries, perhaps. You may want to, because it's where the numbers work. It's not about the emotions. It's just what works for us. Yes?
Yeah, and you're bang on. And it's interesting because at first, that was for sure. I just wanted to pass on my entire portfolio, but now I'm continuing as you grow as an investor and you get connections and whatnot. You just decide sometimes to do some shifts, which is important to always continue to grow. And that's where we're at right now. Is okay, I can hang on to this and hang on to it. That's awesome, and pass it on to my kids. And I know they're set, or I'm gonna still hang on to some of them, but I will sell some of them, and maybe I'll do some private lending on some of them. Some of them I'll go in the States. We're looking at Costa Rica. We're looking at different provinces as well. So just to really diversify our portfolio, as well as staying where we currently are.
Yeah, I don't think you'll do any private lending until you're fully done, because your returns are much higher. Well, they're infinite, really. You have no money in the deal, right? So they're infinite. But yeah, one day.
It's on my radar. It's there. I don't know if you're bang on. I don't know if today's the day, but yeah.
That's what I say, right? Right now, I'm still trying to grow the capital, but there will be a day where, I want to lend out at 8, 9, 10, 12%. That's fantastic. And for those that are watching, if you can build up to even $500,000 or $1 million, that's at 10%, $50,000 a year or $100,000 a year. And life is not about money, but it can help. It can help put cheese on the burger. It could help have your kids' friends all come to your house, and be hospitable. It's great to be able to help people that are less fortunate and be benevolent. So money, that some of the happiest people I know, especially abroad, don't necessarily have big bucks, but it definitely can help as long as we're continuing to work on our marriage, our parenting, our community, all that kind of stuff. And I know that you guys are kindred spirits with that, Mel. And so yeah, it's very exciting. I can't wait to have you back once you do pull the trigger to go into other provinces. What I love so far about what you've been doing is you guys are like I'm in the promised land of Brampton, Ontario. You guys are like 3-4 hours north of me. Mm-hmm. And all, am I right? All your deals have been within a few kilometer radius, and you have, hundreds of doors now, right? That's incredible.
Yeah, no, exactly. And a big part of that was invest where cash flow is best. And that was a big part of our philosophy. And now as we're growing as investors and the market is changing, the North Bay is booming a lot. And we're just seeing other opportunities elsewhere. So it's like, okay, now we've created this, let's put this to work elsewhere as well.
Awesome. Listen, Mel, always great to have you on the show. Time flies when we're having fun. Thank you for your time.
Thanks for having me.
Yes. And thank you guys for watching at home. Without you, we would not have a TV show. Make sure you tune in next week. Same place, same time. Honey, love you. Be home soon. Thanks for watching, everyone.